Anita Anand, leader of the international tax practice at Brady, Ware and Company. As part of the Tax Cuts and Jobs Act that was signed into law at the end of 2017, there are a number of provisions that impact taxpayers with an international footprint. Not only has the U.S. shifted to what is commonly being referred to as a quasi-territorial tax system, but there have been changes to existing tax rules as we have known them for decades. There are new provisions implementing new taxes requiring new calculations, as well as some new incentives in the form of deductions that we didn't have in the past. And as you take a closer look into how these provisions impact taxpayers, the result may actually surprise you. What we have seen is that the overall impact of these provisions does vary quite significantly, merely based on the taxpayer type involved. So for example, what we have seen in some situations is that the overall impact to an individual or to a pass-through entity, such as a partnership or an S corporation, may be harsher than that impact compared to a corporate taxpayer. So whether that was a technical misstep or an intended consequence by the drafters of the tax reform legislation, no one knows. But as it stands right now, there is clear incongruity amongst the different taxpayer types. So what this means is that it is high time for you to go back and reassess your current tax structure to make sure it is still a tax efficient one in light of tax reform. And unfortunately, there is no one-size-fits-all solution. So you need to be working very closely with your tax advisor to understand how these new provisions layer onto existing tax rules and interact with one another. But the reality is that we are operating in a very different tax landscape than we were prior to tax reform. And so although tax planning has always been a very valuable exercise, it is more valuable and more important to do so now.